firm manager today oversees all equity schemes under DSP BlackRock, managing assets worth approximately 39,000 crore rupees. While Anup Maheshwari, Executive Vice President and Head of Equities of DSP BlackRock Investment Managers, joins us now. Anup, good afternoon. Thank you very much for being on Closing Bell.
Thanks, Monica.
So let me start, Anup, by asking you of your assessment of where we stand today, in the market run-up that we've seen through the course of this calendar year, or maybe all the way through late last year, and how much potential you see this market having in being able to move substantially higher from here on.
Sure. So I guess, starting last year is when we started repairing the balance sheet from around September onwards with the new RBI governor coming in place and some more confidence developing around that time. And, we've clearly benefited from a series of unique circumstances, at least as far as India is concerned. So the RBI governor change, the new government coming into play, and now more recently commodity prices going down, all of which tend to be uniquely beneficial to us relative to other markets, that we've seen elsewhere in the world. We started off with the macro repair in a sense, with the top-down beginning to trough out and start getting better. And I think with the lag, we're hoping that corporate earnings will also start picking up. It's not fully evidenced at the moment yet, as we've seen from this quarter as well. But the general assumption, and the same assumption that we're working with, is that we'll start seeing this come through in financial year 16, and most of that repair will have to center around the financial services sector, which has gone through a fairly torrid phase in the last couple of years, particularly in terms of loan quality. So I think that's going to be the biggest change to look for, and one of the key drivers for better valuations going forward, as well as earnings growth coming through for our market. But it's very clear to us that we're in the process of consistent repair, and you get into the virtuous cycle of things getting better. So hopefully now with inflation heading down and expectation generally that rates will be lower sometime next year, I think that also just continues to support higher valuations. So,
Anup, can you talk us through your expectation on the macro front? You mentioned the interest rate bit. I'm curious what your earnings growth expectations are, how quickly you see a recovery in the underlying economy. And the reason I ask you this is because in most of your funds, banking or financial services makes up about 20% at least. And in several funds, it probably goes up to 30%. So you're betting big on that sector being where most of the gains are. Talk us through the investment case, therefore, for it.
Sure. So for a start, it is the largest sector in the index as well.
Sure.
So we are overweight, and by default, therefore, it's a very large percentage of our funds. I think this is one of those phases where both public sector and private sector banks seem to be on a better curve now going forward in the next year or so. So till last year, I think it was more private sector dominated, where balance sheet qualities are relatively maintained and therefore were appreciated even more, and you saw more consistent growth, whereas the public sector banks were facing a lot of stressed assets. I think we're coming to the fag end of that stressed asset phase, and therefore in the next 2 years we're expecting balance sheets on both sides to be fairly good, and that's why we think overall the sector should do well, and that will translate into higher earnings growth. Coupled with that, if we have a scenario where interest rates also start heading lower, we think that will also be...
Is that your expectation, that interest rates will start heading lower than anticipated?
Yeah, absolutely. I mean, they've already started heading lower, so we're not saying anything different. But in terms of the official RBI sort of referencing lower rates, we're expecting that to come sometime in the course of next year. So as long as we maintain this lower inflationary trend, which seems to be the case now, it's logical to expect that interest rates will be lower. And you have to remember, we're one of the only economies in the world today where interest rates at this point are higher than what they were during the Lehman crisis. World over, interest rates have compressed dramatically. So that's a big area for India as far as potential reduction is concerned.
Anup, hi, good afternoon. One look at your portfolio, and what's interesting is that oil and gas as a sector has a very low weight, but there are stocks like BPCL and ONGC in almost all your portfolios or all your funds. Are you a bit more bullish on the PSU side, and do you believe that the big trade that's playing out in terms of oil reforms, that's going to continue?
Yeah, absolutely. So we've been more overweight on the public sector oil companies, both upstream and downstream actually. And these are positions we've carried for a while, so we're quite happy to see the whole reform process come through in terms of greater ability to transmit prices. The point is that, again, in this sector, over the last 3 or 4 years, they suffered from a lot of stress in terms of cash flows at a time where you had to rely on the government to keep paying you at the end of every year. I think those cash flows have now got sorted out to a large extent. And therefore, we're expecting overall ROEs or return on equity of companies in this sector to start rising. And valuations are still very, very cheap. So that's the logic of owning the sector. And I think as long as the government continues in its current vein on reforming and taking things to more market-based pricing, I think that will generally be beneficial to their balance sheet. So that's the reason why we're overweight on public sector energy companies. The reason why we're underweight the sector as a whole is, as you know, Reliance is a fairly large weight in the index, and we're still underweight Reliance. So that's why at a sector level it looks like we're underweight.
Okay, that's interesting. And the second bit is what's happening on IT, because among your bigger funds, I don't see either Infosys or TCS.
Yeah, on IT as a sector, we've been sort of more bottom up in our selection, and overall on the sector itself, we just feel that the sector does seem to be sort of on the verge of slightly lower growth in the next couple of years. Now, in the case of IT, it's you have to be very alive, and it's a little tactical sometimes. So you have to be very aware of changes that are taking place. So we may have to readjust that view at some point. But for now, our view is that you're in a system where there's opportunity cost of capital, and at a time where the economy domestically is beginning to pick up, valuations are still quite reasonable. There is potential re-rating in local stocks. We'd rather be a little underweight where earnings growth is more modest, and look for better opportunities through largely banking and finance.
Interestingly, IT, despite your outlook at this point in time, Anup, continues to outpace the allocations in many of your funds to the auto sector, with the exception of maybe the small cap funds, where auto ancillaries also have a big role to play, etc. Would you see that reverse in time over the next 3 to 6 months, saying, auto maybe holds out more promise, more money will flow towards that, and as you've just pointed out, you might become more cautious on the IT front?
Yeah, it's quite possible, Menka. I think, we are definitely, as I said, we do have a slightly higher bias towards interest rate sensitives, even within consumer discretionary, the whole segment, and that includes auto. We definitely like auto ancillaries as well. It's a matter of really bottom-up stock picking and looking at valuations, because, stocks have done quite well in this segment already. So for us, when we're looking at our portfolio and looking at overweights, underweights, it's relative to our benchmark, and also we're looking for the absolute returns that these stocks have to offer. So at this point, I'd have to agree that we do see more investment opportunities perhaps in the consumer discretionary space than necessarily the IT space.
What do you like in that space, Anup? Can you talk us through some of the stocks at the risk of incurring the wrath of your compliance guys?
Well, I'm never going to incur the wrath of my compliance guys, so I'm not taking that risk.
No, but I mean, so can you talk us through the kinds of stocks that you like, right? Because otherwise we're just general sector conversations, through this. So it'd be nice to get some insight on what appeals to you within these sectors.
Sure. So we like the commercial vehicle space generally, commercial vehicles and passenger cars. And as I said, the auto ancillary space is an area that we have a fair amount of exposure to within that whole auto sort of segment or subsector within consumer discretionary. And then we've got a few unique names in garmenting and textiles, for instance, which are quite unique to our portfolios. But overall, I'd say within the auto space, we're more positive on commercial vehicle oriented names, so more cyclically oriented in that sense, and on the car segment. Within two-wheelers, we're more optimistic on scooters, but there's no real ability to play that view out very strongly.
Okay, in your mid-cap fund, you have 8.3% allocated to textiles. Now, it's public knowledge that Arvind is one of your larger holdings, and that's one stock which has done remarkably well this year. So, two-part question: do you expect this kind of up move to continue in textile, and would you play it via some other stocks as well apart from Arvind?
So I can't sort of discuss stocks specifically, but I can tell you about the way we are approaching this investment. Overall, I think the way we are looking at it is when we're looking at textiles, we're not just looking only at exporters or the conventional way of looking at textiles. We're looking at strong domestic brands as well and good distribution, and that's why this company is one of our large holdings over there. Our sense is, over time there will be more and more desire to own branded products, and even today the scale of most brands in this country today are very, very small compared to the sort of potential size they are overseas, as well as the consumption capability here. So when you look at some of the names, or at least Arvind in particular that you mentioned, you'll notice a whole slew of brands that are licensed out to them for sale in India, and these are all potentially fairly large scalable brands over time. So our view therefore is that when you look at sort of textiles, you've got to look at a combination of perhaps some interesting export opportunities, but you shouldn't ignore the domestic side, which we think can be fairly large and scalable. So that was the whole sort of logic, and as these brand values get established, you go through a curve of profitability where initially you need to invest a lot into the brands, but once they scale beyond a certain level, they start coming through very well in terms of profitability and margins, and then the return on capital improves substantially. So that's the logic of owning that sector.
Anup, stay right there. We're going to take a quick commercial break, come right back and talk to you about specific stocks. That's coming up next.